Hello viewers, welcome back to part 2 of our mortgage elimination financial tip videos. Now today we're going to go through how we could supercharge our mortgage reduction program, which was just using an offset facility to keep all of our net pay in, which would reduce the balance of our mortgage and therefore we'd be charged less bank interest and we'd be paying more principal debt down each payment. To supercharge it, we want to be able to increase our cash flow because the logic is simple. The more money we can put into an offset account that's linked to that home mortgage, the less interest we're going to get paid and the sooner we're going to get it paid out. So if we're putting all of our net income already into our offset, well, as it is, there's no extra cash flow to actually put in. However, what may seem counterintuitive, as I touched on in the last video, was to actually take on an investment property, which would be another mortgage, but it's an investment mortgage. This would allow us to generate more cash flow, and I'll explain how. Firstly, with an investment property, what do we get out of that? Cash flow is rent. So we get rent. Now also, when we're utilising our income tax effectively, we can write down tax, because each property may have between $30,000 and $50,000 worth of annual tax deductions. So if we're able to utilise our tax, we've got an additional cash flow that we can put into our mortgage. So let's say, remember, in that offset facility, every dollar that we've got in our offset facility reduces the amount of bank interest that we're going to be charged on our mortgage, which will allow us to pay back more principal debt each payment. So if I'm bringing in rent, let's say the property is bringing in $20,000 a year rent, $20K per annum. And let's say when we do our tax write-downs effectively, and look, the way that you can get your tax flow in real time is via a tax variation. Your accountant will tell you exactly what you can do to that, but you can itemise all of your tax deductions as far as expenditure, depreciation, outgoing costs, and you can also itemise the income, and you can lodge a tax variation to the ATO. And what that will allow you to do is, instead of waiting for the end of the financial year to get your tax refund based on all of those deductions, you can get it in advance throughout the calendar year in every one of your pay cycles. So what does that also do to your cash flow? It increases it. So by utilising the $20K rent, let's say we're getting only $5,000 a year back in net tax refund, which is a good average. We've now just generated $25,000 annual additional cash flow. And I'll show you how we can take ownership of this investment property positively geared. There's a science to that. But let's say that we've got a positively geared property and it's bringing in an additional $25,000 a year in cash flow. If we put that into our offset facility, what is that going to do to the amount of bank interest we're going to save? Well, it's an additional $25,000 a year that you can sit in your offset by redirecting it from the investment property into your own non-tax deductible principal mortgage. Very, very simple. More money reduces the principal debt balance, less interest charged. So if you're saving on interest, you're earning interest on every dollar. So not only are you bringing in $25,000, every time you're putting it in your offset facility, you're earning 3%. If that's what your mortgage is at, you're earning 3% on top of that as well. So compound that over 5, 10, 15 years. The beauty of it is it will allow you to pay down your home mortgage infinitely faster. But what I also will allow you to do is, once we've paid down your home mortgage, let's say that's costing you $3,000 a month. We've got a positively geared cash flow already. If you now redirect that $3,000 a month for your mortgage, because that's already paid down in half the time, and you redirect that in addition to your $3,000 per month, how quickly are you going to take ownership of that property? So in the same time as you would have paid this down, you'll have both properties paid out. So it's a $500,000 turnaround at no additional cost just by using smart tax and lending strategies. And that's what we're all about. Bye for now. If you found this information helpful or you think it can help someone you know, please share the link or tag them below.